How do we repay the significant amount of borrowing incurred by the Treasury to combat the COVID-19 pandemic? Well, we probably need to raise taxes. Around £40 billion a year's worth of tax, in fact, could be needed to help repay this debt. But what about the idea of a one-off wealth tax designed to repay the debt over the next 5 years or so? That's the proposal from the Wealth Tax Commission. It's generating an awful lot of headlines today, and I think it is a terrible idea, as I'll come on to explain in this video. But before I get to that, please do take a second to subscribe to this channel. We make videos here about personal finance, investing and happiness, so press the subscribe button so you don't miss out on any future videos. But let's take a closer look now at these proposals for a one-off wealth tax and why, if you have pension, property, business or investment assets, you should be very fearful of what's being proposed. The Wealth Tax Commission is a body made up of academics, policymakers and tax practitioners, and they are proposing a one-off wealth tax charged over a 5-year period based on a number of different thresholds for what wealth really means, but based on a threshold of £1 million for a two-couple household. That wealth tax over the period of 5 years, charged at 1% a year, could raise £260 billion of additional tax revenue, which would then go to help repay the public debt incurred by COVID-19. It's being proposed as a fairer solution to raising tax revenue rather than putting up the rates of income tax and VAT, value added tax, so targeting wealthy individuals and couples, wealthy families, instead of targeting everybody through income tax and VAT tax rises. Thankfully, the Treasury have not been particularly receptive to these proposals, saying that they have already put steps in place to ensure that the wealthiest in society pay their fair share of tax. And taxes like this, tax proposals like this, often do come down to an idea of fairness. Who should be paying the most tax? Is it fair to tax poorer members of society more than you tax richer members of society? According to the report's author, this is Dr. Aaron Advani, who is a professor at the University of Warwick, we're often told that the only way to raise serious tax revenue is from income tax, national insurance contributions or VAT. This simply isn't the case, so it is a political choice where to get the money from if and when there are tax rises. So let's start then with this idea of fairness and inequality. And yes, it's absolutely right to say that the pandemic has disproportionately affected poorer members of society. In fact, the Institute for Fiscal Studies did a research on this recently. They showed that the bottom 10% of earners in society, so the poorest 10% in society, were adversely affected by the pandemic, and that's because they typically work in sectors where shutdowns were taking place, so hospitality for example, but also types of jobs which could not easily be done from home. So the bottom 10% of income earners in the UK disproportionately affected. So taxing the wealthy, taxing the rich, intuitively feels like a fairer solution, doesn't it? But it leaves out the fact that wealthy members of society already pay the majority of taxes, both directly via income tax and other types of tax, but also indirectly through wealth creation. So the latest stats I could find looking at income tax, for example, show that the top 10% of taxpayers in the UK are responsible for close to 60% of the total income tax paid. The top 1% of taxpayers pay nearly 28% of the total income tax paid. However, the bottom quarter of taxpayers, the bottom 25% of taxpayers, are projected to pay just 2.2% of the total income tax bill. And of course, there are plenty of indirect taxes paid by wealthy people too, because they create businesses which create jobs. The businesses pay corporation tax, the jobs create wealth, which is then charged at income tax and national insurance. The people in those jobs go off and spend money, so VAT is charged. So it's not just a direct amount of tax paid by wealthiest people in society, it's these indirect taxes through wealth creation too. Let's look at the practicalities of this one-off wealth tax idea then. How do you tax illiquid wealth? How do you tax wealth that is tied up within properties, within pensions, within businesses? It's very, very difficult to do. We come across a lot of people who are asset rich but cash poor, and having to pay 1% of the value of their property each year, or value of their pension fund, or value of their business interest each year would bankrupt them, quite frankly. They do not have access to the cash to pay this one-off wealth tax bill. There is a suggestion in this report from the Wealth Tax Commission that the tax on property wealth, for example, could be deferred until the property is sold, and typically that might happen when somebody moves into a residential care home or when they die and when their estate sells off the property. But would deferred taxation serve its purpose? Would that help go towards repaying the national debt if the Treasury had to wait to get their hands on the tax revenue? You've got a similar issue with pensions and the ability to levy a wealth tax on a pension fund. Would they have to wait until the person retired and access their pension pot before they could levy that wealth tax? And again, there's an issue of waiting. Does it actually serve its purpose if the Treasury is left waiting until people take the money out of their pension? And from a practicalities point of view, thinking about business wealth as well, how do you even value the shares in an unlisted, privately owned business? And where do you find the cash from to pay a 5% wealth tax, albeit over a period of 5 years? So on a practical level, I believe these proposals are flawed. They just simply won't work. It is positive, though, to see the Wealth Tax Commission propose that we should be taxing net wealth, so assets less the value of liabilities, for example, mortgages or other borrowing, because I have to say here in the southeast of the country, property wealth alone would put lots of people over one of these thresholds of £500,000, even £1 million, unless you deducted the value of their mortgage first and looked at the net asset value, not the gross asset value. There are some examples of wealth taxes being used after a period of crisis. So we look back through history, we see that after the Second World War, France, Germany and Japan used them. More recently, following the global financial crisis, there was a wealth tax levied in Ireland. And actually in the past few days, we have seen Argentina levy a new tax on the wealthiest members of its society. The tax in Argentina is designed to pay for medical supplies, but also coronavirus relief efforts, and it's designed to tax people with more than 200 million pesos. That's about 1.8 million pounds of wealth. Around 12,000 people in Argentina will have to pay, and it will be a tax of 3.5% on wealth held within Argentina and up to 5.25% on wealth held outside of the country. Now, whenever we look at tax policy, whenever we look at economic policy, I have to say Argentina is not the best example of how to do it well, but it's just very timely that here in the UK we're seeing a proposal for a one-off wealth tax just days after it being introduced in Argentina. If a wealth tax was introduced here in the UK, the number of people, the number of taxpayers affected would depend on the threshold it was set at. So at the lowest threshold considered by this report, which was £500,000, it would affect 17% of taxpayers. But you rise that to a threshold of £1 million and that goes down to 6% of taxpayers. And at a threshold of £2 million, it is just 1% of taxpayers. I don't think that these proposals have any legs. I don't think anything will come of them. But sadly, it does bring us back to something we've seen in a lot of in recent years and also through history, which is the politics of envy and envy of the rich, so targeting the rich for political gain. And if we think back to the success of high income tax rates back in the 50s and 60s, when some higher rate taxpayers on the top slice of their income were paying tax rates of almost 90%, this does not have the intended consequence. This is not about generating more tax revenue. This is about squeezing the pips until they squeak. And sadly, this, from a political perspective, is what some parts of our political system would like to see happen. But as I say, you've got the law of unintended consequences. Don't expect wealth creators to stick around and pay these taxes if there's other options available to them. So very often higher taxes will drive people out of their country. But secondly, don't expect them to take risks with their money, to start new businesses, to employ more people, because you disincentivize them from doing so. You charge them so much tax that it becomes not worthwhile to do those things to create that wealth in society. And it has the unintended consequence of stopping wealth creation taking place. There are also some strong arguments that taxes don't really need to rise at all, or at least not by very much, in order to deal with and tackle this public debt caused by the coronavirus crisis. One reason for that is that the cost of government borrowing is so low that the cost of servicing the debt is relatively small. The other is the expectation that in the future, given all the money we're pumping into the financial system, we will see rising price inflation. And price inflation helps to reduce the relative amount of government debt, at least the cost of it to the government. So those two factors, the low cost of debt and rising price inflation, could reduce government debt over time without the need to raise taxes by too much. In any case, I don't expect to see tax rises come into force too quickly, probably not even during 2021. We need to get through this pandemic first. And this week, of course, we've had V-Day, Vaccine Day, so we are starting to see some light at the end of the tunnel, but the economic recovery will take time. And add to that on top, we have Brexit, we have the end of the Brexit transition period coming up at the end of this year. We still don't have a trade deal as I record this, although we might get some news on that later today, but that is going to have an economic impact as well. So it is too soon for the Treasury to be hiking taxes, in my opinion. They will need to do it to some extent at some point in the future, but a one-off wealth tax is not the right way to go here. What do you think about a one-off wealth tax? Let me know in the comments down below. Should we squeeze the rich until the pips squeak? What would you do if you were Chancellor for the day? What's the right approach here? Thank you for watching this video. Please do take a second to press that subscribe button so you don't miss out on any future videos. I make videos here about personal finance, investing and happiness, and I'd love to have you on board as I make more of those videos in the future. Until next time, I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.